Let's welcome on board Seshadri Sen, Head of Research at Alchemy Capital Management as well, joining in on the show right now. Seshadri, hi, morning. Great to have you on the show. Can't help but begin talking about IT first. Just on the cusp of lots of earnings this week from the IT majors and, of course, TCS later today. Just wanted to understand whether we are at the fag end of the bad news or at least weak pricing for the stocks.
Yeah, we think that we are closer to the end of the negative cycle in IT than the beginning. In terms of earnings, obviously top line could slow down a little bit given what's happening in the Western economies. But sooner rather than later, you'll see margin pressures start to alleviate. And if you look at the stock prices and valuations, they've compressed pretty considerably over the last 12 months. So we are close to the end of the cycle. I wouldn't, hazard a prediction that it's an instant gratification trade. There may be a little bit of more pain left. Unsure about that, but if you look at a 6-month to 1 year perspective, I think the quality names in IT are starting to look fairly attractive.
Okay, so we are towards perhaps the fag end of the correction as far as the IT sector goes. But what about the new age tech sector? That also saw quite a bit of correction in the year gone by. Do you expect that to follow through, or at least there is a bit of reversal in place for the new age tech companies like Zomato, Nykaa, etc.?
I think similar trends. Maybe they'll take a little more time to recover, partly because of the immense price damage that's been done in that sector. And there is a little bit of uncertainty, especially what's happening in the global internet sector, about the near-term outlook, recoveries. You may see some more cost cutting. But if you take a longer-term view and you pick your stocks carefully, and the three things that we look at are, first of all, good governance. And the last 12 months, there's plenty of data to figure out which of these are well governed and which are not. Secondly, the clear path to profitability, which is becoming more and more visible in many of these cases. And third, of course, one has to keep testing the market opportunity and the long-term growth prospects of these companies, because these are new companies. Assumptions were made of long-term growth prospects when they went IPO. Those assumptions need to be kept testing. But from a 1 to 2 year perspective, some of these names do look very attractive because they are delivering very, very high levels of market share growth if you see the underlying top line.
Okay, so that's about the new age tech companies. And I was reading your views, Seshadri, and one very interesting thing is that you seem to have exited out of life insurance companies because you're seeing better opportunities in bank and NBFCs. A bit surprising because of late we have at least heard a bit more positive, murmurs around insurance companies. What's your take?
Yeah, the insurance companies have gone through major pain. Primarily, I think, because when they were first listed and in the first 2-3 years of listing, they were simply overvalued. I think the market opportunity size were overassessed, growth opportunities were overassessed, and given that it was a new sector, people benchmarked them with the private sector banks in terms of, if this is X price to book, let's put X price to EV on that. And that was, I think, an incorrect way to look at it. It is true that the valuations have largely corrected, which makes them a little attractive. I'm just worried about three things. One, a high interest rate regime is not conducive for growth in the high margin sectors in life insurance. Two, the highest margin segment in life insurance, which is protection, is facing some challenges. Over the last 2 years, they faced challenges on pricing. And there again, the size of the market, we're not sure of. As you go into smaller towns and you go down the income curve, it becomes more challenging to grow that business. So, and some of the growth drivers of the last 2-3 years, like the non-par assured return products, may face challenges in a higher interest rate environment. So I'd be, these are very high quality companies. And for sure the valuations have corrected, so they look a little tempting, but I'd be a little careful in terms of which I pick. because there may be a little bit of overvaluation still there in the system.
Okay. Seshadri, this entire view on capital goods, don't you think it's becoming too obvious and too easy? And markets somewhere could get a little bit disappointed if anything goes wrong on the export front, global front, even on the interest rate front?
Interest rates, not so much. Global, yes, I think that is a worry, but many of these capital goods companies are largely domestic oriented. So if there is a large global exposure, I'd be a little careful. But I do believe that the domestic capital goods industry is on the cusp of a really long-term growth phase. We saw sort of darkish winter between 2015 and 20 when everything slowed down. Also, any company that survived that period and still exists and is thriving well is almost by definition well poised to exploit this what I see a multi-year growth phase in capital goods. So by and large, I think the sector still looks very interesting. But I would be selective and go back to the basics in terms of, again, looking at balance sheets and cash flows for some of these companies. Also, what I think the last year or two in the markets have taught us is that overvaluation is a big risk to stock prices. So we would be a little careful about what valuations we are buying this at. But if you adjust for these factors, avoid those with a large global exposure, avoid those which are very expensive on valuations, I think the sector does look very interesting, and there'll be plenty of opportunities there, especially in the mid-cap space.
You've tracked the banking sector very closely in your previous avatar. What is your understanding of the PSU banks? Is this like a deep swell, more like a trade, not a structural space where you want to park your money?
Stock price performance is stock price performance. Trade versus investment sometimes turns out to be a false binary. But certainly, let me answer this in a different way. In the short term, the PSU banks, their fundamentals look very, very positive. Asset quality pressures have compressed. Loan growth has come back. They are competing in some categories reasonably well with the private sector banks. And of course, the main factor that is driving the stock prices is that they were really, deeply undervalued going into early 2022. Going forward, however, I would think that as we get deeper into the cycle, the fact that they still will struggle to compete in some segments with the private sector banks, that will show up, and we'll see some of these growth rates start to taper off. More importantly, for the entire sector, you'll see a sharp rise in deposit costs as we progress through this calendar year. And some of that we are seeing the first signs of in terms of the way they're raising deposit rates. When that happens, I'm not sure that this kind of outperformance will sustain and the investors will gravitate back towards the more quality names. So maybe this rally will last for another quarter or two, but from a 1 to 2 year perspective, I would still prefer private sector names which have a strong franchise and have a long runway of growth.
So as we look into 2023, what will work? Growth or value? Because if you bought growth stocks in 2021, you hit a home run. If you bought the value stocks ahead of 2022, you never made money. What will work this year?
My view is that at some stage quality will make a comeback. I would still say that and I would qualify the growth and quality stock argument with the fact that I don't think overvalued stocks will perform in the next year or two. I think that phase between 2015 and 20, where you could buy a quality name at any valuation and make money, that era is in the medium term gone. You will, even if you buy quality names, you will still have to look at what valuations you're buying it at if you hope to make money. The rally in relatively low quality names, the value rallies may last for another quarter or two. But if you look at a 1 to 2 year perspective, I think it will peter out at some stage. You're absolutely right. If you look at India over a longer term perspective, you get 3 to 4 years or maybe longer of growth, especially growth at reasonable price being the best performing category. And then you get the odd year in between where value performs and plays a catch up, especially when we are at the beginning of a positive economic cycle, which is what I think we are at. And then again, quality starts to come back. So I would not sort of veer away from focusing on quality names. The only caveat I would put is that be careful of valuations, because overvalued stocks are unlikely to perform from even a medium-term perspective here.
Seshadri, wondering what you're doing with fintech. Those stocks have corrected quite a fair bit. The managements are clearly changing their commentary, saying the right things that the markets want to hear. But is it time yet to buy those stocks?
Selectively, yes. And the reason is that fintechs are genuinely disrupting the space. If you see some of the growth numbers that the fintechs are delivering, they are quite impressive, and they're gaining market share. And they're breaking down the moats that some of the traditional banks have had over, right up to say 2018-19. So as a sector, I would definitely keep an eye out on fintech. The rest of my answer is the same as the one you asked about new age tech, that I would look at, one, how the management quality is and how the governance is. Two, what in those specific categories, what the long-term growth opportunities are, and of course path to profitability, which, to be fair, most fintechs have started to focus on and are showing a very good glide path to profitability.
Okay, Seshadri, we'll let you go on that note. Appreciate you joining us on the show today.